Good afternoon, Dr. Yoon. How are you?
Hello, Colin. Thanks for having me.
Thanks for being here. What a crazy few weeks it's been. We saw you about 4 weeks ago in Miami for a National Association of Realtors event, and you gave us uh, a stellar update on the economy and what we were looking at in the future. Uh, do you have to throw that away now? Is it completely different?
Only a crazy event would have upended the forecast where I actually did not believe we would have an economic recession as of just 1 month ago. Everything was lining up well, record low unemployment rate, record high stock market, housing market on solid ground with home prices rising, too much demand, not enough supply. But suddenly everything is coming to a halt. It's like hitting a brick wall, essentially 1/3 of the economy to say shut down, travel industry, restaurants, you can no longer work. So completely different picture at the moment.
So, absolutely, and it's pretty incredible. I've heard comparisons to the two most recent big shifts in the real estate market, and you've been with the National Association of Realtors since 2000 and became their chief economist in 2007. So, you were here for 9/11, and you were with us also for the economic downturn in 2008 and beyond. Uh, this really isn't like either one of those. This is something completely different. Would you agree?
It's uncharted waters. I think this type of event is first time in the U.S. history or even a global history where we have this situation. The Spanish flu right after the First World War, what people really do not know, other than many people got sick and died from that. But this one, we are trying to prevent the spread and the health hazard of it, and consequently, government mandated economic shutdown. So consequently, we will see some very ugly economic numbers in the upcoming months. Some people are saying GDP numbers. Usually one say 3% GDP growth is good, -2% is a recession. We may get -20%. But that is not as important as what happens afterwards, because we know that the numbers will be very ugly because it is a government imposed economic shutdown. But now we have the stimulus package in place. The Federal Reserve is going all in to help on the cash flow problem. So whether we have a V-shaped recovery, that is to say sharp downturn, but sharp rebound, so we really don't see any meaningful change on a year over year, say home sales numbers, or whether we are going to have a U-shaped recovery. We go down, we stay at the bottom point for several months or several quarters before sort of slowly climbing out. So we don't know, but the stimulus package is to hope that we get a V-shaped recovery.
So you touched on a couple of different things there, and some of the commentary that I see on social media and in conversations with realtors and even clients around the country is that there's a lot going on and there's a lot to unpack. So one of the great things about having you on right now is that literally Congress just passed the stimulus package, which is the third tranche of stimulus to go through Congress, waiting to be signed by the president, who said he's going to sign it urgently. But that's very different from, say, what we're looking at when the Fed reduced their rate to 0%, and also different from the quantitative easing that we're seeing again for the first time since the end of the last recession. Can you help us regular realtors on the ground understand how each is different from the other? Maybe let's start with the 0% Fed rate, and then maybe go into quantitative easing a little bit, and then maybe we can talk a little bit about the package.
The Federal Reserve does not directly control mortgage rates, but by controlling what it's controls, something called Fed funds rate, you hope to nudge some of the long-term bond yields, like 10-year Treasury, which then subsequently mortgage rate follows that. So back in 2008, Federal Reserve cut interest rates when they saw the signal for recession, and they did 7 rounds of rate cut throughout the year. This time around, the Federal Reserve is saying we're not going to wait 7 times. We're going to do it all at once. So it's all in process. And furthermore, when the quantitative easing was announced last time back in 2008, people are questioning, what is that? Why are you doing it? In essence, the federal government or the Federal Reserve, independent from the White House or Congress,
Mhm.
is printing money to buy government bonds or mortgage-backed securities in order to keep the liquidity flowing, keep the interest rates low. and they set a number like $3 trillion or $4 trillion, which they said they will slowly unwind as economy normalize. But this time they went all in and say now unending quantitative easing. And this is to assure that every loan product, there is a liquidity, whether it's a municipal bond, jumbo mortgages, certainly government-backed Fannie and Freddie mortgages, all that will be smoothly functioning.
Okay, so that actually brings me a question that I got because I posted on several different sites that we would be having this conversation, and I got a great question from Julie Malta, as a matter of fact, specifically related to that. And her question was, what conditions do you foresee with liquidity going back to the mortgage market? The federal government seems to be the big player buying up the agency loans, but this has impacted the non-QM financing and some jumbo lending resources. So how does that affect jumbo loans, or do they even touch that?
So anytime there was a crisis, first people panic and they want to go to the safest asset, which is the U.S. government bond. They assume that government will always repay the money. And the mortgages that are backed by Fannie and Freddie, essentially it has government guarantee. So if someone was to default on their mortgages, I mean, most people don't know that their mortgages are backed by Fannie and Freddie, but about half of the US mortgages are backed by Fannie and Freddie. And if that was to default, the US government will repay the investors for that. So Fannie and Freddie backed mortgages or conforming mortgages, it also has the liquidity, but it is the non-conforming, either jumbos or those that do not meet something called QM rule. That means that either the credit score is a little low or the debt to income ratio is a little bit out of the parameters. Then the investors know it doesn't have a government guarantee. So that market quickly gums up and freezes, and interest rate could actually rise significantly. And the goal of the Federal Reserve is to say, look, there are many areas, whether municipal bonds, non-conforming mortgages, corporate debt, it could quickly gum up, and therefore we want to provide a liquidity so that people would not have this situation. And it's the right policy. I mean, some economists would debate on economic theory, but this is a situation where we had hardworking Americans just working at low unemployment rate, and suddenly a virus appeared and government is saying you have to shut down the restaurant. So this is no fault of anyone. So in essence, why we want the liquidity to flow.
Would this be a good example of a time to highlight why government-sponsored entities like Fannie Mae and Freddie Mac, it's so important that the government has a role in them? And all too often, especially in our May meetings annually, we have discussions with federal legislators to say it's a huge part of the economic engine behind housing in this country and provides stability, and they encourage that they want them to move more towards a privately funded as opposed to a publicly funded piece. Right now, you're seeing that. I believe that's what you just said, that there's a potential that the jumbo loans, which are privately backed, their interest rates will soar, where our rest of our consumer rates that are attached to Fannie and Freddie and government-sponsored entities will actually stabilize, if not fall. So would that highlight the example that when the economy gets shaky, the private money gets more expensive and they run away?
Well, Colin, thank you for raising that question, and thank you for participating in important NAR committees to determine NAR policy. And we, brought some economists look at pros and cons of it. And NAR policy is to assure that there is a government guarantee of mortgages, because without Fannie and Freddie, which some people say let's completely privatize, that means that without government guarantee, it could lead to higher interest rate environment at a time when we need lower interest rate. We want the consumers to enter the economy, not back out of the economy when the economy is sinking. So the government guarantee is very important. Another area of contrast is commercial mortgages, because many of the office, the warehouse, where they get their financing, mortgage-backed, commercial mortgage-backed securities, it would also freeze up and interest rates would rise. If there was no Federal Reserve coming in with this massive quantitative easing. So it's the quantitative easing that is helping the liquidity flow at the moment.
So for right now, when we're still fairly new into this piece, like I said, a month ago, we were having a completely different conversation. Obviously, the longer this lasts, the more long-term damage will occur to the global economy, not just the United States. I mean, Yes, we had the global slowdown in 2008 and 2009, but you still had China and some other economies providing very positive and big number GDP growth, albeit not as big as it had been previously, but they were still there. This is the whole world shutting down, the economic engine shutting back down. What's it going to take to start it back up?
It's good that all governments are recognizing, whether the European Union or independently, say Germany or Britain, they're also providing quite sizable stimulus. The U.S., I think that the amount they are putting out, $2.2 trillion stimulus package, equivalent of 10% of GDP, in essence, to say make up for all the lost income. What's in it include, for example, people who got laid off, so that their income is totally replaced through the enhanced unemployment insurance package, and also for some small businesses who have been holding on to those workers, but now they are running short on cash. Well, provide small business loans so they can retain those workers, and those loans will be forgiven if they don't lay off workers. Again, the goal is to say it's the virus, not some economic mismanagement that's leading to. So China is providing stimulus, Korea, Japan. So every country, I think, is recognizing the severity of potential economic downturns of providing it. So it is possible that if somehow a vaccine is discovered in the upcoming few months, that everything returns back to normal quickly, or if somehow that the social distancing really works so that people who are sick stay at home, but people who are tested and not sick, maybe they can go back to work with social distance, and that will begin to stimulate the economy. So there are many possible scenarios, but current scenario is to say, let's not have people lose jobs or lose income, which will then feed in itself and lead to further job cuts. So we want to stop the bleeding and hope to raise some consumer confidence. One controversy, I guess, on the stimulus bill is that some people who are recently getting unemployed, say who were working as a cashier job, minimum wage, their unemployment check could actually be higher than what they were making. And but maybe that provides the confidence and get the money circulating into the economy so that the tenants who are in the retail store can pay those rents. And we don't have a problem systematically across the country.
Well, I think the size and the scope of the rescue package, or the stimulus package, if you will, we'll be learning about that in the coming weeks and months. I mean, it's unprecedented to see something this large at this expenditure level get passed so quickly. And so we're going to, and somebody actually emailed me a copy of the entire bill last night, and I'm like, I can't read that. It's hundreds of pages long. So I don't know who creates this so quickly, and obviously the opportunity to thoroughly vet and review it is just not a luxury we really had. This is just something that had to happen, which is why both parties ultimately at the end said, hey, we know it's not perfect, but this needs to happen quickly. One of the unique pieces that I'm seeing in this, and we've been tracking this, is it's the first stimulus package of any that I've seen, certainly in the 2008-9 era, that had a piece in there specifically for independent contractors. I mean, one of the things that as realtors we say is that if I don't sell a house next year, I don't get to draw unemployment. It's a risk I take by getting into this. But here we actually have the recognition that we are an active part of the economy. We contribute to the tax base, we pay Social Security and all of these things. And NAR worked really hard to help the federal government understand that we also need to have some of a cushion there to move through this piece.
Absolutely. The one quick portion I think everyone knows about is the checks, $1,200 per person that is going out. And then the other part is the enhancement on the unemployment insurance. Generally speaking, people need to be on the payroll of someone where you have the organization paying portion of the tax, the employee paying portion of the tax. So the independent contractors were always out of that picture. But one thing that we were lobbying is to say, look, again, this is a virus-induced economic shutdown, and therefore independent contractors should also be eligible. Now, it is highly entrepreneurial business. I have heard from some realtors to say that they're just as busy now after the virus as before, so they're doing very well. But we also recognize there are realtors who are not getting their businesses, and they also need assistance, just as other people who have been suddenly hit this brick wall that leading to the sluggishness in the business activity.
And that brings up a great point in terms of, we've always said that real estate is local. And this demonstrates that to a whole other level in terms of I'm in a fairly rural community in Oregon, or suburban / rural community. So how I conduct my business here is completely different than, say, somebody in a very urban area like where you're at, or close to DC or Chicago, where you've got realtors that have these massive condominium complexes, and that's the only place they sell. They are the realtor for that complex, and yet showing there in a stay in place type of order really means stay in place. They can't actively show that property. Whereas here, if I'm showing a rural piece of property, observing the social distancing is actually something that I can do safely. Now we're doing it at a much less level, but it's fair to say that how we conduct our business is also very different from broker to broker, from geographic area to geographic area. So it's completely understandable to see how some realtors will continue to do business and observe all the appropriate guidelines into how to do it safely, whereas some simply don't have the option to do that.
Realtors are very resourceful. I mean, they're using more virtual tours. Interesting data point is that things like Century Lock box openings, so people actually visiting home, that is actually plunging. I mean, it's a large decline. Naturally, there's some buyer interest that disappear from the stock market correction, or people are just being patriotic. Governments say stay home, so they are staying home. But what we do find is that contract signing is not declining all that much, which is telling me that people are doing more serious searching of homes virtually. So in the past, maybe people visited 10 homes physically before deciding. Now people have really narrowed down just through online viewing, and they just want to view 2 homes. So the actual viewing, opening of the Century Lock boxes is declining sizably, but the contract signing is declining only moderately. But the local to local, it will have variation. Seattle is a perfect example. It was the epicenter of the initial breakout of the virus. So there was a lot of orders put in place, but people could still show homes, and homes were selling in Seattle. But as of today or tomorrow, I believe that has to stop according to the government mandate. So that's going to completely change the dynamics of what's going to happen in the Seattle market.
Yeah, and we've seen a lot of realtors get really creative in terms of how their showings can be out there now. And the other great piece I think that we've seen from this is the unity amongst the realtor community, and understanding these are unique times, and how we're showing property either virtually or otherwise has changed. And our cooperation amongst our peers acknowledges the fact that this is different than we've ever done it. I might have said no to you 2 weeks ago, but I'm saying yes today because we're all trying to make this work in a way that everyone is healthy and everybody is safe. So that's one of the most encouraging pieces to come out of this, is we're seeing ourselves operate more as a family and as a connection. Also for our clients, I mean, they still have expectations in how they want to purchase or sell a home. This isn't obviously being driven by realtors, but we're very aware of what our clients' needs are. They may want to take advantage of those interest rates. They may want to take advantage of prices right now, et cetera. So very uncertain times, and really difficult for people to make strong decisions on housing right now. What's your sense, if you can? I mean, interest rates seem to drop to really close to 3%. And then they ticked up very, very quickly right about the time of quantitative easing. Now that the dust is going to settle just a little bit financially, hopefully, do you have any idea of what we might expect from the traditional 30-year conventional mortgage going forward?
I think it will be close to 3%. Under historical spread between 10-year Treasury and 30-year fixed rate mortgage, it should be, I mean, the average mortgage rate should be more closer to 2.6, 2.7%. Maybe we will get there, or maybe there is, as mortgage rate always bottoms, pretty much bottom at 3.3, but I think we can get to 3%. I think for some serious buyers, again, it varies by local to local, is that inventory shortage has been the major hindrance to buying. But now that some of the demand has retreated, so if people have a very secure job, people working in the healthcare industry, wow, what a heroes they are, or people who are working for the government, education, people with very secure job, knowing that there's less buyer competition, interest rate being low, maybe this is a great opportunity to make those serious home search, virtually or online first, and then working with the realtors to make some physical visits. We also work with the government to say, look, massive stimulus package. I mean, there will be some mistakes here and there, but overall it's the right policy. So why don't we also include to say that the appraisals process, one do not have to go interior of the home, and they could do just exterior. I would say 90%, 95% are probably done right. Maybe 5% go through the cracks, but that's the nature of where we have to compromise given the nature of the situation. So fortunately, many appraisal, only exterior appraisal would be sufficient to get the mortgages moving along.
Yeah, and I think that that's a great point, is we're going to hopefully see historic lows on mortgage rates, which will stimulate buyers to continue through that process and maybe take advantage of something that may not come around. I say hopefully for the right reasons. Again, in our lifetime, at least for these circumstances, we love low rates, but maybe not under the circumstances. In our market, we're like everywhere else. Again, everything's local. We have a luxury market. We have a couple of luxury markets, and we have a lot of other different types of markets here. And so some of our buyers are directly impacted in terms of their down payment ability to stocks and bonds, and those took a big hit. What's your sense, if any, on what the stock market might do?
Stock market, one never knows because it can be overly exuberant and also it can overreact during the fearful times. But I think if there is historical lesson is that back in 1987, when it was a major stock market correction, people were extremely fearful. But then it bounced back. So people who held on or people actually invested when the stock market crashed, they did extremely well. Furthermore, back in 2001, internet stock market bubble, same situation. When the subprime market blew up, stock market crashed. But from the low point, or at least until the recent stock market crash, I mean, that was a very good return. And maybe, the stock market is a good early indicator about many things in the economy. It's still, down measurably from the peak level. We are seeing some weakness on the upper end market. It had been the case also prior because of the limitation on state and local income taxes and also mortgage interest deduction, but it exacerbated where you see home prices on the low end very solid, but the upper end market, home prices have been somewhat soft or they need to do price reduction. And now with the stock market correction, I think more giving has to be done by the home seller. But on the low end, we are still seeing that even in this environment, that multiple bid is still prevalent.
Yeah, well, that's good to hear. So there's still some health in the market, but typically the higher end homes are a little more exposed in the lower end because there's less demand. And maybe their buyers are more impacted by that stock market piece than people that are shopping in that lower price range in their particular market.
Yeah. So I think, people in the current environment, again, if someone has a very secure job, I would say it may actually be a good time to search for a home and knowing that there's less buyer competition. But if one is fearful of the job, they should not enter the market. Home buying is a major expenditure. People need to feel very comfortable financially, but also that emotional comfort level. They need to feel that what they are buying is they're making the right decision. Now, I will also say that back in 2008, we saw that home prices plunged 30%, but that was a unique circumstances of subprime lending, people overstretching their budget, and also home builders built way too many homes. Today, we are completely opposite. We don't have subprime lending, and also builders have been underproducing. So I would say overall, home prices are on much solid ground this time around.
Excellent. Well, as always, you're a tremendous resource for all of our realtors across the country. You're so plugged into the industry on all levels. And I really appreciate you taking the time to talk to me today, especially today with the package coming out. And hopefully we'll have an opportunity to visit and check back in the near future and kind of see how things are moving along. But in the meantime, I wish you and your family all the health and safety that you can have at home as the rest of us are doing. And hopefully we'll be back on track real soon.
Yeah, more family bonding time. Stay safe.
Awesome. Thank you, Lawrence. Really appreciate it. Take care.